Hello, everyone. Today on the Final Bar, we'll start this week off right. We'll look at what happened today, but really look at the big picture. We're going to dig a little bit into the S&P 500, continuing to hit that 4,300 level. Last week, we stalled out, what we call that power on stall. Do we power through, regain the upside momentum? Some individual stocks like Cruise Lines, Adobe, and others say yes. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down the action in the markets using the best practices of technical analysis. The technical toolkit is really designed to quantify investor behavior, to really measure the performance of stocks, and really by doing so, measuring the behavior of individual investors. We aggregate all of those buy and sell decisions into price, and price is fact. By analyzing trend and momentum, different ways of breaking down the price activity over time, we can better quantify trends. We can better understand when trends are occurring, because John Murphy, our chief technical analyst, really pioneered or popularized that message that markets do indeed trend, following on the work of Charles Dow, of course. And we have a lot of other tools, a lot of other indicators to try to measure performance and measure strength and weakness, the price momentum, as we may want to call it. At the end of the day, it's all about analyzing the stocks and ETFs that are of interest to you and focusing on where the opportunities might be. Today, we're going to talk a little bit about the FAANG sectors, right? Communication services, technology, consumer discretionary. At the top of the list today, yet again, we're seeing further strength in the major benchmarks. 4,300 in the rearview mirror for now. Is there enough upside momentum to keep going this time? We'll have to see what we can see when we break down the chart of the S&P, some other charts as well. Let's get to our market recap. As I mentioned, a nice day for growth sectors. So if you're in a tech or communications sector, you probably had a pretty decent day. Let's look at the particulars and see how things actually played out. The S&P 500 finishing the day around 4339. That's up almost 1% from Friday's close. The NASDAQ Composite up even more, about 1.5%. The NASDAQ 100 leading the way higher, up 1.8%. Now, often I'm asked about the VIX, and I've had a lot of great discussions with Dave Landry, one of our other StockCharts contributors, about volatility related to stocks. We are so programmed to think higher stocks, lower volatility, higher volatility, lower stocks. And over time, in general, that has happened. But today is one of those days when stocks are rallying and the VIX is actually rallying as well, which is a little unusual. Usually there's a bit more of an inverse relationship. But for today, for what it's worth, the VIX actually getting back up toward 15. This is after going below 14. The end of last week, we're looking at the VIX making a new low for multiple years, down below the lows of 2021. So talk about a low volatility environment. We're sort of there. Today's sort of moving back to the upside. I think that's an important chart to watch through this week and certainly through the Fed meeting to see what sort of volatility. You would assume plenty of volatility around this Fed meeting because there's certainly some uncertainty surrounding what the Fed may do next. Usually a bit of a quiet period leading into a Fed meeting like this. We have two key metrics to pay attention to this week. CPI number coming in tomorrow. And then we have the Fed meeting Tuesday and Wednesday. Wednesday is when we'll have the press conference with Jerome Powell. We'll have the latest updates, and all of that. And that's when things can really move. And during the press conference after the Fed announcement, usually a pretty crazy period for stocks, pretty volatile. So certainly pay attention at that point. But usually there's a quiet period, sort of Monday, Tuesday leading into it. This week's going to be a little different because of the CPI number coming out tomorrow, and that certainly has some market moving potential. For what it's worth today, not a lot of change in the short end of the curve. So the short end, the 5-year point, pretty similar to where we were on Friday. 10-year and 30-year points both up by, let's say, 0.2, which takes us to 377, we'll say, on the 10-year, and just around 391 on the long bond on the 30-year. Dollar index, not too much change from Friday, to be honest with you, sort of similar. Same can be said for gold. So dollar and gold kind of similar to where we were on Friday. Commodities as a whole move lower, and that was really crude oil prices pushing to the downside. The USO is down about 4.3%. You can see other parts of the commodity complex sort of mixed, but oil came down quite a bit, and that's the biggest weight in most commodity ETFs because they're weighted around with the different types of contracts. Tend to have sort of an energy accentuated by energy or a higher energy weighting than other parts of the commodity space. So when oil prices are weaker, it usually brings down the DBC as well. And you can see the energy sector, the worst performer out of the 11 today. Over to cryptocurrencies, Bitcoin continuing to push to the downside. And you had a bit of a noise over the weekend. It's sort of this big drop in yesterday's session. Bitcoin currently around 25,800. This is down from 30,000 not too long ago. So it's only down about 0.5% today. But a lot of that movement happened over the weekend. Ether, same thing, moving lower, just above 1,700. We'll look at the chart of Bitcoin here in a minute if we have time. Just to finish off looking at sector movements. As I mentioned, it was the FAANG sectors at the top and then everything else. Technology leading the way higher, up 2.2%, followed by consumer discretionary, and then communication services. One of the charts we featured last week, maybe Thursday or Friday, I forget which one, was looking at what we call our offense versus defense chart, right? XLY versus XLP, and the equal weighted versions of those as well. Clearly has been favoring offense or consumer discretionary over stables. Today, yet another move in that direction. The cap-weighted version very clearly favoring the offensive side of consumer discretionary, sort of a risk-on feel. The equal-weighted version as well. So it's very much in a risk-on positioning right about now. Let's go to a daily chart of the S&P, and as always, just see how today's movement fits into the big picture. So, the question mark going into the weekend, and when I was writing a note for my premium members at Market Misbehavior for Saturday morning, we talked about the importance of that 4,300 level. Last week, we compared it to a power on stall, right? That's when you're taking off in an airplane and you put plenty of power in the engine, which you need to kind of go maximum power to get off the ground. But if you tip the plane up too much, all of a sudden things start to get a little squirrely, and you basically stall out. You prevent the plane from producing, or prevent the wings from producing enough lift, and you kind of stall out, and if you don't do it right, you can go down very, very quickly, which is what you're trained to avoid. The market for now is doing a pretty decent stall recovery. If those of you are pilots or student pilots, you know what I mean. That's what you're taught, is to have a good recovery. How do you regain control of the plane and then continue a climb? We're starting to see that today. Now, when you break above a key resistance level, which we're doing today, I would say, right? We've talked about 4,300 to 4,325. We closed the day above there today at 4,338. So what's the question? The question is follow through. On a big breakthrough day, I would argue it's all about tomorrow. Do we see further accumulation? Do we see further buying power? Do we see further demand for stocks pushing the benchmarks above this level? We've now closed above it. What happens next? Because whipsaws will happen where you'll close above and then the next day you go right back down. That's when a bearish engulfing pattern sort of jumps off the chart at you and you go, uh-oh, this is short-term weaker as opposed to stronger. So nice day, nice way to start the week. Very interesting that we're going into, of course, the CPI number, the Fed meeting. Those two things certainly have the ability to move the markets very quickly to the upside or downside. We get, muted inflation data, which would be the May reading that we'll get tomorrow. If we, in a favorable sort of dovish tone from the Fed, it would be very easy to expect that the S&P could accelerate to the upside, particularly with the growth leadership that we saw on a day like today. That's how markets can push to the upside very, very quickly. Now, a couple of thoughts before we go on. Number one, the RSI is just barely below the overbought region, but it's really, really close. The last time the S&P 500 was overbought was in February of this year, August of last year. Both of those times, of course, I basically identified the two most significant tops that we've had in the last 10 months. So be wary when we get to that overbought region. Even if the trend overall continues stronger, you usually expect a bit of a pullback, particularly when we get out of that overbought region if we get up there. Now, the other thing you could do is, again, things like price trends breaking through levels, sort of a confirmation indicator. Something like RSI, an oscillator, is more of a leading indicator, right? It tells you when conditions are similar to previous tops and previous bottoms. One other thing you may want to think about with something like this, because I'm often asked, how do you know when the trend is no longer up? I would argue the price is the best indicator of that, but what about something like the PPO or the MACD indicator? Look back over the last 12 months and look at when the MACD indicator, the PPO indicator, has been above zero and then has given a sell signal, right? And most of those times, maybe the April one was a little more of a consolidation phase, but every one of these, we stopped going up, and in most of them, we actually went down and had a pretty decent drawdown afterwards. This is still bullish. This is still telling you that the trend is positive. If we do get a pullback, you watch this indicator to see if we see a sell signal. That would tell me to be sort of risk off and be wary of a drawdown. Depending on your long-term approach, that actually could be a decent time to get back in, right? It depends on how you're thinking about the markets at any given point. Quickly wanted to look at a chart of Bitcoin because we've talked about cryptocurrencies sort of off and on as the evidence, I think, makes it deserve attention. If you look at the Bitcoin chart over the last 3 months, I think you have what I would loosely describe as a head and shoulders top. You see the rally in the first quarter of the year into the peak in mid-March. We make a higher high in April and then a lower peak here in May. That's the head, the left shoulder, the right shoulder. It's almost what you call a complex head and shoulder when you have multiple left and right shoulders. But in either case, the neckline is the interim lows between the two. We broke below there in May. We briefly broke back above, tested the 50-day moving average, and now rotating well below it. The momentum is firmly in a bearish phase, right? Not getting above 60 on a rally and really remaining, in the bottom half of that range. So overall, this is a chart in a distribution phase. What would tell me that the downtrend in Bitcoin is over? Number one, we start making higher lows. Number two, the momentum starts to improve. We rally and the RSI gets above 60. Maybe we find support around the 200-day moving average. That would be a reasonable level that you might expect support. That's what happened in March of this year. But for now, I'm seeing a downtrend. A trend line connecting the highs might be another one as well. Draw some of those on the chart and see when we see a rotation higher in Bitcoin. That's when you can start to get excited, I would argue, about the upside potential in a chart like this. Of course, the FAANG sectors have really been strong here today and recently. We've talked about the strength and growth. I just want to highlight that the New York FAANG Plus Index is testing all-time highs. So this index is really the FAANG stocks and then other similar names like Twitter and others were kind of in there. It's sort of a mishmash of stocks that are sort of in that FAANG sort of growth mega cap type of arena. And if you look, just like Apple is testing all-time highs, a number of other stocks in the space are sort of bumping up significant resistance from the end of 21, beginning of 22. This FAANG Plus index is kind of getting there as well. So if you ask me what the bear case is, or the case for limited upside above 4,300, I would say charts like this, where we're testing all-time highs. We break through all-time highs, all bets are off, and I would say that there's a lot of daylight above that all-time high, but we have to get above 8,000 first on the FAANG Plus Index, and we have not done so yet. Folks, let's take a quick commercial break. We'll be back answering some of your questions from the Final Bar mailbag. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We so appreciate you joining us every weekday after the close for our show. A lot of great plans for this studio and for StockCharts TV here in the coming months and years. We're excited to continue to update you on the markets and give you some insights and expertise to help you along your investing journey. A couple quick announcements before we answer some questions from the Final Bar mailbag. First off, the mailbag is fueled from questions from people like you. Shoot us an email with questions as they come up in your own investment process. Our email is thefinalbar@stockcharts.com. We're also on Twitter at FinalBarSCTV. And of course, our YouTube channel called StockCharts TV is filled with expertise and guest commentaries. Check it out. Put a comment below the video you're watching on our YouTube channel. We'll hope to answer your question live on the air on Friday's show. Upcoming schedule, of course, a big week with tomorrow. We have the inflation numbers coming out. Gina Martin-Adams of Bloomberg Intelligence is going to be coming through to give us her take on Fed Week on inflation and what to expect. Of course, Fed Day on Wednesday, so we'll be digging into the latest updates from Powell and crew and what that means for the markets from a technical perspective. On Thursday, Doug Ramsey, who's the Chief Investment Officer at the Luthol Group in Minneapolis, is going to be joining us on the show for the first time. Let's continue on today answering your questions from the mailbag. Thank you guys so much for sending these in. And here's question number one. Dave, I understand the value of relative strength, but in 2023, isn't that just pointing you to big benchmark names? And you had a longer question where you talked about, and this actually came from our special we did not too long ago, where Aaron Swenlin, Grayson Rose, and I all shared our picks for our favorite indicator. And Grayson Rose talked about relative strength. And this was one of the questions we got after that special. And thanks to Grayson and Aaron for sharing some expertise with our viewers. When Grayson's talking about relative strength, I wholeheartedly agree. And to be honest, if Grayson had not picked relative strength, I certainly would have done so because it's my favorite way of really visualizing relative performance. We're looking at the chart of Home Depot here, and the very simple idea between relative strength is when you look at the ratio of the stock versus a benchmark. So we're doing it versus the S&P. The line is going up, it's outperforming. The line's going down, it's underperforming. Now, any technical analyst like myself who has worked with institutional investors, big money managers, hedge fund managers, all these, we are laser focused on relative strength because as a money manager, that is essentially how you are evaluated. That's how your compensation is calculated. And a lot of times it's based on your ability to beat a benchmark, which is actually incredibly difficult to do. I will tell you from firsthand experience of working with money managers trying to do so. It's just not easy, particularly the S&P, which is a tough benchmark among tough benchmarks to try to outperform. But owning stocks where the relative strength line is going up means you're doing your job and you're in the names that are generating alpha, or generating more return than just the regular market return, which we would call beta. Now, what you're alluding to, which is 100% right, is if you look at some of these larger names like Microsoft, Apple, Nvidia, Netflix, Amazon, the relative strength lines, particularly in 2023, have been incredibly strong. And that's because of the nature of the market in 2023. It's been dominated by stocks like Microsoft, right? The mega cap names. And if you ignore those names from the return list for the S&P 500, the returns are pretty meager for everything else, right? Sort of a mixed to down year for a lot of stocks until relatively recently. But these names have had a pretty good year. So, is it just pointing you to the big benchmark names? Right now, I would say for the most part, it kind of is. Now, it's not totally. And I would say there are other names, like an RCL, Royal Caribbean, I mentioned cruise lines in our market recap. There are other names that have actually had really strong relative strength. And it's not permanent, right? There are periods where, if you look back at 2021, kind of a nice consistent uptrend led by the FAANG stocks. But then in 2022, very different environment. All of a sudden, energy, materials, these are the sectors doing incredibly well. Their relative strength lines all rotated higher, while the FAANG stocks, their relative strength lines turned lower. So the idea of it is to focus on stocks with strong relative strength and bet on strong stocks continue to be strong. That tends to work over time. It tends to persist. Then you tend to get some clear indications when that's changed. I think for now, you're right. The lion's share of the stocks with strong relative strength are those big mega cap names, but there are others, right? Think home builders, think gold stocks until about a month or 6 weeks ago. Think semiconductors, of course, and not just the mega cap ones, but some of the smaller ones. Some stocks have actually done particularly well. By screening and by looking for stocks with strong relative strength, you're going to figure out whatever that opportunity is. Whether or not it's the largest names, I would bet on the names with the strong relative bets. By the way, I created this view in ACP. I was showing Grayson Rose this on Friday. It's loosely based on a chart that he and his father Gaddis Rose have used, where it's an ACP view with 5 different charts. And here we're looking at relative strength: Royal Caribbean versus the S&P, Royal Caribbean versus its group, which is called recreational services, the scooter ranking, which is essentially a similar measure, but it's just a percentile ranking based on trend strength, and then the stock versus consumer discretionary, and the group versus the sector. And you can see with Royal Caribbean, all of these lines are trending upwards. That's a strong stock with strong relative strength conditions. So I'd encourage you to check out ACP as a good way of visualizing some of those relative strength trends. Let's get to question number 2. Dave, do you primarily use daily or weekly charts, and why? And I think that's a really good question. What's interesting is you sort of forced me into a binary choice. And I would say I primarily use daily and weekly charts would be my snarky answer to your question. I use both of them. But your question is, what's your primary use, or where do you focus? So on the show, my default chart is this one, right? And so we're asking me about electronic arts. I'm going to bring up this chart with the 2-year daily price, the RSI, and then the relative strength. And I do that for simplicity. I do that because on a show like this, we have limited time together every day, and I just want to make sure we have a clear chart that we can analyze together and draw some clear conclusions. When I'm actually analyzing things for a client, when I'm working at a larger firm, and we're going through ideas, and I'm going through like hundreds of charts every day just to look for things, my view would look a lot more like this, where I have multiple time frames all together. So I'm looking at the daily chart in the upper right, the monthly chart in the lower left, the weekly chart bottom middle, the daily candle chart just to focus on the candle patterns, and then relative strength, because we mentioned, and this is a working version of ACP that I was working on last week, and just reminded me that we had these multiple timeframes on here. I think multiple timeframes are super important, and the general way I would think about a stock, if you asked me the first time, is to look at the monthly chart and think of the overall trajectory. Where have we come from? What's the story of Royal Caribbean over the last 15, 20 years? Then look at the weekly chart. I would often zoom in and out of these, of course, to sort of get a little more data in there. What's the last couple years been like, right? Are we coming off of any major highs or lows? Where are we at relative to where we've been? Here with Royal Caribbean, I can see we've rallied well, but we're really testing resistance from 2021. We're kind of back to that significant overhead area of resistance. That's important for me to know. But in terms of execution, how I would actually pull the trigger, it all goes back to the daily chart. And my goal would be strong stocks, strong trends that have pulled back. So a chart like this is probably a little too extended to pull the trigger today. I probably look for some sort of pullback, maybe to an ascending 50-day moving average. Often ends up being a pretty good place to scale in. So that was a long-winded way of saying I kind of use both, but my go-to is a daily chart. I'm usually looking out about 1 to 3 years, but depending on your time frame and your investment horizon, if you're in a retirement account looking many years down the road, or if you're more of a swing trader looking a couple days, couple weeks at most, that should define what chart you use primarily. For me, it's weekly and daily, and probably daily more than anything. 2-year daily chart is kind of my go-to, but I tend to use weekly and daily charts often. If you watch Grayson Rose's show, by the way, you will often see him show his methodology, and if you can ever get him to show you underneath the hood what he does, he has this very well-articulated process looking at weekly and daily charts, building them with different indicators, and it's a brilliant way, I think, of leveraging the StockCharts platform to really allow you to understand the interplay between those different time frames. Great question, by the way. Next one, where can I find the Mindful Investor Live Chart Pack? You mentioned you found the coffee routine, the morning coffee routine chart pack, but you couldn't find that one. And I am here to help you out. So if you go to your dashboard on StockCharts, the chart packs that you mentioned, so there's two different things, right? A chart pack, if you go to what's called chart list, these are all your lists of charts. I have an incomprehensible list of too many charts. At the very bottom, you have this gray button that says Manage Chart Packs. And if you go here, this is the one you'd mentioned, the Morning Coffee Routine Chart Pack. If you click on that, it gives you more detail. If you've not explored these, a lot of them are free. We do have a couple premium chart packs in here, but the free ones are really good. And when I was just learning the StockCharts platform, I spent a lot of time looking at Arthur Hill and Carl and Aaron Swenlin's and others, and asked Gaddis, Grayson Rose, and Tom Bowley and Greg Schnell for some ideas of what charts they looked at. That really helped me understand how to use the chart list pretty well. The chart pack that you see here is what I learned from that and how I have my account set up. I'd encourage you to start there if you're not really sure what you're doing. But you were actually mentioning the chart list. And if you go to the Articles tab on StockCharts, up here where it says All StockCharts Blogs, you will see The Mindful Investor, which is my blog. And at the top, there's this little gray button that says Live Chart List. There are also all of these articles that I've written for StockCharts, but if you click on Live Chart List, this is a live list of charts that I keep updated on the StockCharts platform. I update them at least once a week, and often in the middle of the week, I'll drop a little note or change some settings if I think it's important. I refer to these charts regularly on this show, so probably a lot of them look familiar. If you want, you can always come back to this same link if you bookmark that, and it'll have my latest charts with the latest settings. However, as a member, you're also able to save it to your own chart list, and then there are your own copies of the charts, which you're welcome to tweak, send, share, delete, whatever you want to do with them. So if you want to take what I did and then build off of that, save it to your own chart list, you can edit all the settings yourself, but that link will show you my latest versions with all of my notes. Next question, probably the last one for today. Can you discuss the difference between Bollinger Bands and Keltner Channels? This is a meaty one. Let's see how quickly I can break this down. So these are two different techniques. So let me go to a really clear chart here. and we're going to add the two indicators. So they're both under the overlays section. This is Bollinger Bands. This is Keltner Channels. I'm not going to mess too much with the settings just for simplicity. So this is pretty busy, but in blue you have Bollinger Bands. In red you have Keltner Channels. These are very similar indicators. Both of them are based on a moving average and then bands around the moving average based on volatility. And the difference is just what moving average they use and how they calculate the volatility. Chester Keltner was actually an investment strategist, if I remember right, in the 1960s. Linda Raschke really popularized the use of Keltner channels in the 1980s. She really, did a lot of work and promoted them. John Bollinger, of course, a thought leader in terms of how to use bands and think about volatility. The difference is this: Bollinger Bands use a simple average, usually a 20 or a 21 day. We default to a 20 day, and then it's two standard deviations above and below. Those are those blue bands. Keltner channels use an exponential moving average, so it's a little different. And then it uses average true range to calculate the band. So because of those differences in calculation, you'll find they move very differently. And one of the challenges, and I guess a benefit of Bollinger Bands, is when there's a big move, because the standard deviation is so sensitive, the bands will blow out very, very quickly. And again, follow John Bollinger, look into some of his work to find, he's written books on how to use these, and I think, incredible insights on how to think about volatility. Keltner's version is a little different. You can see it tends to follow the price a little more closely because average true range doesn't tend to be as noisy. So as a result, a big move is not going to kind of shock the bands and explode them out too much. I would argue there are benefits to either of them. Bollinger Bands are more popular, and I think that's more of a marketing outcome than because they are necessarily better or worse. I would encourage you to go through our chart school section. It's free on our website. You can go through either one of them or both. You'll see the calculations, see the formulas. Draw your own conclusion as to what you find is better between the two. We need to wrap this show, folks, and go to the 3 in 3, 3 charts in 3 minutes that tell the story of this market environment. Here is chart number 1. We're looking at a chart that I call my risk on and risk off chart. I got that question about the Mindful Investor Live chart list, and so I spent some time this morning going through all of the charts in there one more time, just really thinking about why I put each of these charts in here. And this chart was the first attempt I ever had done, or a version of that first attempt, of just trying to quantify risk, right? Risk on versus risk off. Besides my market trend model, which I'm a big fan of course, in a very biased fashion, what else can I use to gauge how investors are rotating from a risk on to a risk-off positioning? And that's the key, is it's looking at ratios between different parts of the market to gauge strength or weakness. So we start with the S&P 500 at the top. We're looking at this measure of offense over defense. I've spoken about this often, but this line's going up. That means consumer discretionary is outperforming consumer staples. That's more of a risk-on environment. We certainly have seen that in the last 6 to 8 weeks, much stronger than we've seen really since the beginning of this year. The relative strength of semiconductors is an important one to watch. This tends to be sort of a bellwether group, sort of the backbone of the modern economy, you could argue, and certainly of the technology that we're all excited about, particularly AI. It's all about semiconductors and what these companies are doing, and the upside potential in these companies and their ability to grow the use of technology. These charts going up is what's so impressive. Now, the other parts of this are a little less risk on, and this is all about leadership. Small caps are still underperforming. Equal weight S&P is still underperforming large cap weighted S&P. Now, the market can go up clearly with these lines going down. However, I think looking for this line to turn can be a great input into a potential risk-on field, particularly from the small cap space. Chart number 2, a different way of thinking about leadership is looking at the ratio of the Qs versus the diamonds, right? The NASDAQ 100 versus the Dow 30. This line was going straight down until the end of last year, turned on a dime, and this year has been going straight up. Go back over the last couple years when I talk about our growth-oriented benchmarks and why growth stocks doing well is so important to the S&P and the NASDAQ. Just look at this ratio at the top and look at the S&P 500 itself on the bottom. When this line is going up, the S&P tends to be doing well. When this line is struggling, the S&P tends to be struggling. Not all the time. There are times when they differ, but overall, that is the general sense. So strong S&P year to date is driven by strong growth. This ratio turns. That can be a serious problem to look out for. Finally, I love the question about relative strength. And again, I gave you like a 2 to 3 minute version. That could be a day-long masterclass on using relative strength. That's in my head for someday down the road. But looking at stocks with strong relative components can be really valuable. Here we're looking at 3 cruise lines: Royal Caribbean, Carnival Cruise Lines, Norwegian Cruise Lines, all three of these making a new high for 2023. And NCLH, Norwegian Cruise Lines, the one just doing it today and just getting above the November high from last year. You're seeing strength in this space. It really speaks to the strength of the consumer and the upside potential. But those charts are saying risk on. Folks, that's a wrap for the show. Thanks so much for joining us every weekday after the close for the Final Bar. I'm Dave Keller at StockCharts.com. Have a great night. We'll see you tomorrow.